Welcome to the Investor Education Series, Separating Myths from Truths, the story of investing. First, I want to acknowledge you for investing your time for yourself and for your family to get educated on investing. It's possible that this information could make a big difference in your investing experience and in your performance. The first assertions that I want to make are, number one, there are 4 destructive myths about investing. Number 2, there are 3 academic theories that dispel these myths. Number 3, academic application to build a better portfolio. And 4th, there's an opportunity to achieve true investing peace of mind. There are 4 myths about investing. So what is a myth? It's a traditional story, especially one concerning the early history of a people or explaining a natural or social phenomenon, and typically involving supernatural beings or events. Some common investing myths are going to be number 1, stock picking, number 2, track record investing, number 3, market timing, and number 4, the cost of investing. Now, understand as I go through these, many times you look at these and we're calling them myths and you might say, but isn't that how you're supposed to invest? Well, I'm going to give you some data and you'll look into seeing if the way that traditional investing has worked is the right way to go before I go into some strategies and solutions on a different way to possibly invest. So we'll look at what not to do and then we'll look at what you could do. First is stock picking. That is choosing stocks based on a belief that they will do well in the future. The myth is that investment advisors or yourself can consistently and predictably add value through individual stock picking. Now, when I talk about stock picking, understand that I mean in all of its forms. It could be individual stock picking, or it could be that you're purchasing a mutual fund, maybe inside of your 401k or outside, where you're hiring a manager that then is going and buying and selling stocks. So that is still a stock picking or an active mutual fund. So I want to give something called survivorship bias for you to think of. This shows a list. It's a very busy chart, but it just shows all the mutual funds that have been opened throughout time. Okay, so when you look at the total number that have been there, it's been about 68,000. And if you look at the funds that are open now, it's about 32,000. So what does that mean? So you've had more than 37,000 that have been killed off, or they're dead mutual funds. Well, what does that mean? What that means is sometimes the data we look at, since it's only from the funds that have survived over time and the bad ones they got rid of, it actually makes things look better now than they actually were. Because if I took the worst 200 dead funds and looked at the rate of return, it's negative 86.13% average cumulative total return. Now that's not a very good return. So this chart I want you to spend a little bit of time at and look into what it's actually saying, because this evidence I think that you will find will make you think, how can that be? So what I'm going to take here is, number 1, let's understand, we're going to look at the average U.S. mutual fund returns. Well, what's a U.S. mutual fund? Well, that is where the big names that you know and that you've heard of, and people put their money with these mutual funds. They hire a money manager who buys and sells stocks that they think are going to beat the market, because there's no reason to be buying and selling stocks unless you're trying to beat the market. Well, if you invested $100,000 way back in the early 70s, it would have grown to 4.9 million. So the first thing to understand is these mutual fund managers or stock pickers, they've got these huge research teams, they've got these huge companies behind them, they're the smartest, the wisest, and the brightest. And did they make you money? Well, sure they did. 4.9 million, 100,000 to 4.9. However, if you look at the S&P 500, the 500 largest U.S. companies, or you look at the CRSP market index, which is just every stock on the stock market, you can see you would have had 11 million. So if you just bought every single stock on the market, you actually would have done better than the professional money managers. So what makes you think you could do it on your own? Maybe you can, maybe you can't, but it's something to think about, because these are the pros with the research department and they're struggling to do it. So if you took nothing else from this, you could actually, I would advise that it might be wise just to buy every stock in the market and go about your business. However, there is even a better way to do that, in our opinion. There's a way that you could actually build a portfolio using empirically tested academic strategies that are Nobel Prize winning, by the way, to achieve a great rate of return. So here we're actually going to not just look only at United States equity or stock funds. Here we're actually going to include bond funds in the mix. So 100,000 with the average of all funds would have grown to $2.3 million. But if we used this mathematical approach, which I'm going to cover a little bit later, and you put 25% of your money in stocks and 75% in bonds, you could have almost $4.3 million. Or you did 50% stocks and 50% bonds, you could have $9.3 million. Or you did 75% stocks, 25% bonds, you could have had over $18 million. Or if you're really cool with being aggressive and you wanted to go all in, possibly over $27 million. So by being efficient, which we will explain how to do that, you can put yourself in a better position to have better performance within your portfolio. But what you first need to look into is, do I want to continue down the path of stock picking? Then number two, there's track record investing. What is track record investing? It's the use of performance history to determine the best investments for the future. The myth is finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. So number one, have you ever heard of past performance does not indicate future results? The reason they tell you that is because it's true. So let's take a look at something here. Let's say that we go back in the year 2000 and we're looking at how you're going to design a portfolio. Well, if somehow in advance I knew who the best stock pickers or money managers would be that run these mutual funds using U.S. equity funds, and I got the top 30 and said, put your money in here, your return, as you can see for the next, from 2001 to 2010, would have been 15.83%, versus if I look at the crisp 1 through 10, which is the total market, it would have been 2.55. So you would have actually done like 12% better per year by being with those money managers, which would be awesome. That would be fantastic. The problem is that's not how it works. The way that it works is you show up in 2010 and you go, where should I put my money? And a typical advisor would look and see who did the best and go, wow, look at these 30 money managers. Obviously, they crushed it. They did it for 10 years. They must know what they're doing. Surely they'll repeat it in the future. So you put your money there. And then you can see your return would have been 6.32% versus the crisp 1 through 10 average annual return of almost 14%. So what people do is they see that, and then they move their money typically, every 4 years or so to whatever did well in the past, and then the results just don't work out. And here you can see we ran it for a shorter time frame. Top 30, if you had known in advance, would have been 31, which beat the market, which was closer to 12%. But then the next 5 years, though, because you're getting in after the fact, you get a little over 9% versus 16% per year. A manager's ability to pick stocks in the past has little to no correlation with his or her ability to consistently do so in the future. There's a lot of brilliant people that they put in the media and they put on the magazines, and then you never hear about them again. See, they're always talking about who did it in the past. They're never able to say who's going to do it in the future. Consider that. The third myth, market timing. Market timing is any attempt to alter or change the mix of assets based on a prediction or a forecast about the future. How many people know the future? The myth is money managers are able to utilize market timing to effectively predict up and down markets. There's a study called the Dalbar study, and what it does is it looks at the average investor's returns and it compares it to the top 500 companies, the S&P 500 index. As you can see from a long period of time, here we're looking at it right at 30 years, the S&P 500's gotten pretty good returns, over 10% per year. The average investor, though, only 6.24%. So it's not that people don't make money. It's just they're not getting everything that is there to be made. Why? A big reason why is because either individuals investing on their own or individuals working with advisors, as humans, we tend to want to buy whatever did well in the past or recently because we have biases, and then we're always moving after the fact. And this plays out in the real study. This is dangerous. Look, if you were in the market from April 1st, 2001 to March 31st, 2021, so 5,000 trading days, 20 years. If you just stayed in through all the ups and downs and the pains and the crazy things that happen in the world, you would have went from 10,000 to 50,000. That's 5 times. But if you just missed the best 30 days, you actually lost money. 30 days out of 5,000, 30 days out of 20 years. Let that sink in. The real evidence that market timing doesn't work, though, is the lack of evidence that it does. In other words, if someone could do it, you'd know about it. They would have so much money, it would be ridiculous. Now, you've got to beware that people don't normally say, oh, we're going to get all in the market or all out. They use something that's a little more disguised called tactical asset allocation. And that just means they're going to say, well, I'm not saying we'll get in the market all or out of the market altogether. What we're going to look at is all the different areas of the market, and we're going to make a forecast or prediction of where each area is going, and we're going to overweight the areas that we're predicting are going to do better and underweight the areas. That sounds logical, but all that is market timing. They couldn't pick the stocks. What makes you also think they're going to be able to pick the areas that are going to do better? And normally people combine both of those things based upon someone that did it in the past, and that's how they proceed with their investment strategy. And that's what the media is always talking about. That's what Wall Street's always talking about. I love this quote by Charles Ellis. The evidence on investment managers' success with market timing is impressive and overwhelmingly negative. Myth 4, the cost of investing. Cost of investing. These are fees incurred by investors to buy, sell, and own stocks or mutual funds. The myth is what you don't see can't hurt you. So let's look at the cost of investing. Understand that there's a couple of costs. There's what's called the mutual fund expenses. Most people are familiar with that. That might be, this particular mutual fund cost has a 1% expense ratio. But there's also the bid-ask spread. For those of you that have ever done any online trading, you know there's a difference between the bid and the ask price. So it might be that the sell price is $49.50 and the buy price is $50. So the market maker actually gets the spread. This is a hidden cost. And so that you've got to understand that as there's more stock picking and market timing going on in the portfolio, not only might that impact taxes, but it's also impacting the bid and the ask and the number of transactions happening. And that can be a significant cost. Here you can see that for, let's just look at micro companies. The average bid-ask spread is 32 basis points. So a trade both ways would be around 64, 65. So that's more than 0.5% that you could lose in that. These are costs that you may not see. The bid-ask spread as a percent of price is an estimate of the actual trading cost. The estimate is over 8 times as great for the smallest market segment as for the larger market segment. So what are you going to do? Well, we'll get into how much should you have in the small segment, how much should you have in the large later. The key question under the new rules of the game is this: how much better must the active manager be to at least recover the cost of active management? The answer is daunting. So far, let's look at what we've talked about. The MIS, stock selection, track record investing, market timing, and the cost of investing. And the reality is, as you look at those, you're probably going, wow, that's what I thought a money manager was supposed to do. And hopefully we've presented the evidence to you to see that that may not be such a good idea. Now, there are 3 academic theories that dispel these myths. And so we're going to get into what's called the Mattson method. It is an investment approach based on 50 years of sound academic investing research and accepted financial theories. A disciplined approach that seeks to capture market returns while managing volatility. What are the components? Component number 1 is efficient market hypothesis. Component 2 is modern portfolio theory. Component number 3 is the 3-factor model. So, who's behind this? Okay? There are brilliant minds in economics that put together novels upon novels of material in statistics to analyze what the market does. If you recall, earlier we looked at stock picking and the data of what the average mutual funds, which are the smartest, the wisest, and the brightest of stock pickers and money managers in the business with the best research teams, and how they were not doing very well against the market. The question is, why is that? And that's the type of economic theories that Harry Markowitz, who was a Nobel laureate in 1990, University of Chicago, worked on. Merton Miller, also Nobel Prize laureate. These are very distinguished economic masterminds. Rex Sinquefield, co-author of Stocks, Bonds, Bills, and Inflation, MBA, University of Chicago, St. Louis University. Roger Ibbotson, co-author of Stocks, Bonds, Bills, and Inflation, a professor of finance, and a School of Organization and Management at Yale University. And one of my favorites, Eugene Fama, distinguished service, Graduate School of Business, University of Chicago, and Kenneth French, who is also a professor of finance at the Tuck School of Business, Dartmouth College. This is what goes behind why the data I showed you earlier, even though it's the traditional way of investing, doesn't work. So let's take a look at each component. The first component is efficient market hypothesis. In a free market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. What the concept is here is we've kind of got to go back to what we looked at in the very beginning when we talked about stock picking. Remember how the average U.S. mutual fund manager or stock picker had trouble outperforming the markets by a significant margin. And you wonder, how can that be with the research teams that they have and the companies that are behind them? And this is the reason why. The argument, the economic theory, if you will, that's here says that whatever it's currently priced at is actually the right price. Let me give you an example so you can think through it. Let's look at your home. Think about the value of your home. Is it worth what you think it's worth? Is it worth what the tax appraiser says it's worth? Is it worth what, even if you paid and got an appraisal, says it's worth? Or is it worth what someone will actually pay you for it? When you think through that, you go, makes sense. It's what buyers and sellers are willing to trade at. Stock prices are the same way. And this is the reason why we have mountains of data showing where stock picking fails. Now, maybe you have a disagreement with that and you say, you know what, I don't think free markets are efficient. I think they fail. Well, that would mean the market fails to price goods and services efficiently. It is possible for some individuals to identify in advance which prices are inaccurate. Underpriced or overvalued markets can be forecasted or predicted. Managers seek to increase returns and avoid losses by taking advantage of stock or market mispricings. People with this view should use the traditional investment approaches. You should do stock picking, market timing, and track record investing. The alternate belief is that free markets do work. So see if this aligns with you. The free market is the best determinant of market prices based on supply and demand. All available information is factored into the current price. All available information is factored into the current price. Only new and unknowable information and events change the pricing. The randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. People with this view should utilize free market investment strategies, which is what we're discussing. So look in your world because beliefs dictate action. If you think free markets work, you should focus on capturing market returns. Eliminate traditional investment strategies. Utilize asset class or structured funds. Diversify prudently. Identify your risk tolerance and work with a financial coach who shares your market belief and helps you pursue your investment objectives. If free markets fail, then you should focus on active management, pursue traditional investment strategies, stay connected to multiple sources of financial information and read as much of the market information as you can, and I'd say even be the first to read it, and work with a financial professional who shares your market belief. There are plenty of financial professionals that will work with you in stock picking, market timing, and track record investing. Component number 2, modern portfolio theory. Diversification works. These are Nobel Prize winners in 1990, Harry Markowitz, William Sharpe, Merton Miller. Dr. Harry Markowitz, he won the Nobel Prize in 1990 as a graduate student in economics at the University of Chicago. In the 1950s, Dr. Markowitz won acclaim for his studies on portfolio design and risk reduction. These concepts were later crucial in the development of modern portfolio theory. What is it? Here it is simplified. You could go out and buy the S&P 500 index, the 500 largest US companies. You'd have a high risk around 18 with a return that's pretty good above 10%. However, using this type of efficient strategy, you could go, you know what? I want the return of the S&P 500, but I'd rather move over to the efficient frontier, getting less risk between moderate and growth and get the same return. That would be possible. Or if you're okay with that kind of risk, move up in between growth and aggressive and give yourself the potential for better return. Now, this is what I call is my happy hour pie chart. What do I mean by that? Well, if I'm at happy hour and I'm at the bar and you're having some drinks, as soon as someone finds out that I'm in the financial services business, inevitably the question is going to come up, and you've probably done this too, of what do you think the market's going to do? What should I be in? And what investments or stocks should I have my money put towards? Interestingly enough, that actually has the smallest impact on what someone's long-term rate of return is. It's actually on how they do their asset allocation that makes up 92% of the return that they get. So how you actually diversify your portfolio. But you see, nobody's at the bar going, well, how should I diversify my portfolio to the different asset classes to give the maximum possible return within a risk level I have? Nobody asks that. And people aren't realizing that there is a way to diversify prudently. That's what we're finding. We're finding that it's like going to the grocery store. If I go without a recipe for my wife, I'm going down the aisles and I get some cereal here and maybe some candy bars here and a steak and whatever. I'm just throwing a bunch of stuff. It doesn't make sense. When I have a recipe my wife gives me, then I'm actually putting the right ingredients that are going to matter. Same thing with your portfolio. Most people just buy a bunch of stuff and think they're diversified. They have never measured what the actual correlation of those assets are. You want to find assets that perform differently at different times. So let me give you an example of how low correlation can potentially benefit you. Looking from 1970 to 2020, you could go buy the S&P 500 index, a return of 10.74 with a risk of 16.68. Cool. What if we added international to it? Now our return goes to 10.58, so a little less, but a little less risk at 16.35. Then I could add international small, and look what happens. Now my return goes up to 11.11 with a lower risk level than I originally had at 16.32. It's possible to increase returns and reduce risk by using modern portfolio theory. Then the last component, the three-factor model. This is very powerful. This is what Eugene Fama and Kenneth French have put many papers and books and novels together on. Well, what is it? Well, first is the market factor. It's just equities or stocks are riskier than fixed income. Equities historically have provided a higher rate of return in what we would call is the safest asset of the world, T-bills. And as you can see, S&P 500 is what we're measuring equities by at over 10% return versus T-bills at over 3%. But yes, there is more risk in equities than there is in T-bills. The second factor, this is the size of the company. See, I can go out and buy the 500 largest U.S. companies as measured by the S&P 500. But what if I bought smaller companies that are still publicly traded? Do I get higher return for the higher risk? And the answer is that's what's showing up in most time frames. The third factor is the value factor. This is where you have high book-to-market value stocks are riskier than low book-to-market growth stocks. High book-to-market stocks historically have provided higher return than low book-to-market stocks. Now, the word value gets thrown around all the time, so I want to give you more of an academic definition. If I've got the book value of a company here, normally a company trades up here. Sometimes that price drops down and you get the trading price closer to the book value. I would actually call that a distressed company. So there is more risk. Something is wrong. But as you can see from these data points, there's higher return. So what's the academic approach? It's saying, you know what? The market is efficient, which is cool because now we can apply math and science through the modern portfolio theory and the three-factor model, which equals the Mattson method. And that is how we're going to apply academic research to build a better portfolio. Now let's put all that together. Let's look at what the average equity investor, if you recall, we talked about the Dalbar study showing what the average equity investor returns are. It's about 6.24% with a risk of 17.63. Well, if you just bought the S&P 500 index, that would be a return of 10.7 from this time frame versus a standard deviation of 17.3. The Dalbar study shows people want higher return with less risk, but yet they're getting less return with more risk. Why is that? Average holding period, 3.5 years. If you say you're a long-term investor and you're only holding for 3.5 years, are you really? Track record investing, you're chasing the market after the fact, chasing returns after they've already taken place. Active stock picking and market timing. These are the reasons behind such low numbers. And sometimes people are unaware of it. They don't even know. They just go, well, my account did well, but they're unaware of what was potentially available. Now let's put it all together. How do you create a diversified portfolio using the empirically tested Nobel Prize winning academic strategies? Well, let's look at the S&P 500 as portfolio number one. 10.74% rate of return with a risk of almost 17. We're looking from 1970 to 2020 so we can factor in international. Well, let's add something safe to the portfolio, 40% in bonds. Now our return drops 9.33, but our risk drops significantly to just above 10. What if we add the international, both large and small companies? Now our return's 9.96 with almost an 11 standard deviation. And then lastly, it's bring it together. The small value and the large value. And look, we end up with a return of 10.58% and the low risk of 11.51. This is how you achieve taking all these principles and putting them into play in the real world. Number one, we need to have a way to invest in our bonds to the extent that you cannot take 100% market risk. Some money goes into bonds, and you should use high quality, low duration bonds. We utilize the free market fixed income fund. Then you want to have U.S. stocks. So here we show the free market U.S. equity fund, and the percentages that you see here, I want to give some clarification. These are not percentages based upon a forecast or prediction of what's going to happen in the future. We're actually looking at each of these asset classes and looking at the work that Harry Markowitz did in the Efficient Frontier and calculating the correlations between each, the standard deviations, and the potential returns of each of those to figure out the right percentage to put into each. Once that's decided upon, for instance, 15% to the small cap, well, then you just buy every small company for all intents and purposes inside of that segment. So you're not doing stock picking, market timing, or track record investing. And then we repeat that with the free market international fund to make sure we're hitting all the segments internationally. And the end result of this 60-40 portfolio is you have broad diversification. The final portfolios that we put together is almost like building a pension plan for yourself in over 20,000 different positions, in over 20 different asset classes, in over 40 different countries where there's markets, and 80 different countries if you include those companies where they have operations. So there is an opportunity to achieve true investing peace of mind by utilizing these empirically tested, Nobel Prize winning academic strategies. And this is what we want to dive into next time we get together to look to see how we can do this for you and your family. Thanks again for spending the time investing in yourself and your family to do this education, to learn more, to create a new possibility where you can transform what the investing experience is like for you and potentially have better performance.